Good afternoon, everyone. Today is the third questions MCQs we're going to go through from the same exam, October, November 24, version 12. We will use this answering questions every day to explain and review the chapters as well. So let's go to the question today. Okay, so the question today is saying, it was question 2 from the same exam. A trader bought new fixtures. Okay, he paid half the purchase price in cash and agreed to pay the balance at a later date. As I said before, and I always say it, the answer is in the question. Okay, they asking us, how does this purchase affect the accounting equation? So first of all, they're asking us if we know the accounting equation. So what is the accounting equation? It's assets equals liabilities plus capital, or capital plus liabilities. So it affects three items: assets, if it exists, owner's equity, and the last one, it will be liabilities. So the question here, first thing, accounting equation, assets equals capital plus liabilities. Second, what does that affect? It affects the statement of financial position. Okay, and we can go through the full statement of financial positions if we want. However, to answer this one, so it affects the statement of financial positions, assets, owner's equity, or another word, capital, and liabilities. Assets, whether it's non-current assets or current assets, liabilities, which is non-current liabilities or current liabilities, it doesn't matter. It's just asking us about the accounting equation at this point. Let's go to the variables he's giving us. A trader bought new fixtures. What does it mean, new fixtures? Okay, new fixtures means we need to identify this word. We need to identify whether it's assets, owner's equity, or liabilities to put it in that accounting equation. Fixture and fittings is part of the assets, which is part of the non-current assets, because we cannot. Why non-current assets? Because we cannot change that. It's not liquid enough. We can change it into money in less than 1 year. So the difference between the current and non-current assets is basically the period which we can liquidate that assets. We can make it money. So if we take cash, for example, cash is a liquid. I can change it in a minute into cash. I can go and withdraw it from the bank. So that means it's current assets. The second half of the questions, he paid half the purchase price. The important for me here, purchase price and the word half. So paid purchase price. So that means he bought an asset and he went and paid half cash, half at a later date. Later date means, and agreed to pay the balance at a later date. Pay the balance at a later date means here it's on credit. So he hasn't paid for it yet. So the question here, number one, let's go to the table. We bought a new fixture. Did we have that fixture before? No, we bought a new one. So that means we identified as an assets, non-current assets. Has it increased or decreased? No, actually we bought a new fixture. So that means we added a new fixtures to us. So that means the assets increased here. So do you understand the logic I'm going through? One is we identify the item, new fixture, it's an asset, it's a non-current assets. So we bought it, it's become a new items in our assets, so our assets increase. The assets as well, one of the questions you need to ask yourself as well with that is the assets debit or a credit account? The assets is a debit account. So once it's increased, it stays in the debit. If it's decreased, it goes to the credit. But at the moment, all of what we're interested in is the new fixture, when it came in, it increased the assets. He paid half. So that means what? He paid. The word paid here means my bank account gone less. Okay. So I want to find out did I pay? How did I pay? So I paid half in cash. So my bank account has decreased. So fine, that's the bank account has decreased. Okay. Did it affect the assets? Yes, it affected the assets. Okay. However, did it affect the owner's equity, the capital? No, it hasn't been touched. It's just the bank went less. Okay. So we bought, for example, a fixture $10,000 and we paid $5,000 in cash and $5,000 on credit. The 5,000, see, the assets was worth 10,000. So the assets increased by 10,000, but then we paid half, let's say 5,000. So the assets decreased by 5,000. So in total, the assets still increased by 5,000. So here, this is why we pick increase. So it's now when I picked the word increase here with using those two items, now I have that the assets, I confirm that the assets will be increased. So it's either C or D. Coming to the rest, when I pay cash, as I said, half cash, the bank decreased. But where is the other half? The other half is to creditor. So basically, it will go to accounts payable. The half, I will pay it later. Accounts payable, in that case, what is it? Accounts payable is a current liability, okay, which I need to pay it within a month, 2 months, depending on the agreements between me and the creditor. So accounts payable here, which part is affected? It's a liability. So has it increased? Yes, it's increased because of I haven't paid it yet. So the debt on me has increased by 5,000, let's say.